In 2019, a financial planner in Minneapolis posted an unusual spreadsheet to an online forum. It showed a married couple, both teachers, who had accumulated over $500,000 in a single account most Americans either ignore or misunderstand completely. They hadn't inherited money. They weren't stock market savants. They had simply opened a health savings account in 2004 and treated it not as a medical piggy bank, but as what financial experts now call a stealth retirement account. This is the story of how an HSA can become the most powerful tax-advantaged vehicle in your portfolio. According to the IRS tax code, an HSA offers something no other retirement account can match: a triple tax advantage. Contributions go in tax-deductible, reducing your current taxable income. The money grows tax-free inside the account, with no capital gains or dividend taxes. And withdrawals for qualified medical expenses come out tax-free. The Employee Benefit Research Institute published research in 2022 confirming that this makes HSAs mathematically superior to both traditional and Roth IRAs for healthcare spending. No other account in the U.S. tax code offers all three benefits simultaneously. But there's a gatekeeper: the high-deductible health plan. According to IRS regulations updated annually, you can only contribute to an HSA if you're enrolled in an HDHP. For 2024, the IRS defines this as a health plan with a minimum deductible of $1,600 for individual coverage or $3,200 for family coverage. The out-of-pocket maximum cannot exceed $8,050 for individuals or $16,100 for families. The Kaiser Family Foundation reported in their 2023 Employer Health Benefits Survey that approximately 31% of covered workers were enrolled in HDHPs, up from just 13% in 2009. The IRS sets annual contribution limits that increase periodically with inflation. For 2024, individuals can contribute up to $4,150, while those with family coverage can contribute up to $8,300. There's also a catch-up provision. If you're 55 or older, you can add an additional $1,000 per year. The Treasury Department data from 2022 shows the average HSA contribution was only $2,100, meaning most account holders aren't maximizing this opportunity. Financial advisors interviewed by the Wall Street Journal in 2023 consistently cited this undercontribution as one of the biggest missed opportunities in retirement planning. Here's where the stealth retirement concept emerges. Unlike flexible spending accounts, HSA funds never expire. They roll over year after year. The strategic approach, documented extensively in financial planning literature, involves paying current medical expenses out of pocket from taxable accounts while letting the HSA balance grow untouched. The key insight, according to a 2021 Morningstar analysis, is that you can reimburse yourself for those medical expenses decades later. There's no time limit on HSA reimbursements, as long as the expense occurred after the HSA was established and you keep the receipts. This creates what tax strategists call a tax-free withdrawal option. Devenir Research, which tracks HSA data, published a case study in 2022 of an account holder who accumulated $80,000 in documented medical receipts over 15 years while his HSA grew to $240,000. At retirement, he could withdraw that $80,000 completely tax-free by claiming reimbursement for those old expenses. The IRS has never imposed a statute of limitations on this practice. Financial planner Michael Kitzes documented this strategy on his blog in 2020, noting the IRS only requires that receipts be retained and expenses be substantiated, not that reimbursement happen immediately. But accumulating six figures requires investing the HSA, not leaving it in cash. Morningstar's 2023 HSA research found that 80% of HSA assets sit uninvested in cash-equivalent accounts earning minimal interest. Only 20% of account holders invest their HSA funds in stocks, bonds, or mutual funds. Yet the same research showed invested HSAs averaged 7.2% annual returns over the previous decade, compared to 0.5% for cash HSAs. Fidelity Investments, one of the largest HSA custodians, reported in 2023 that their invested HSA accounts had average balances of $44,000 versus just $4,800 for cash accounts. When compared directly to a traditional 401k, the HSA's advantages become stark. Both offer tax-deductible contributions and tax-deferred growth. But according to retirement researcher Wade Pfau's 2022 analysis, The 401k requires you to pay ordinary income tax on every withdrawal in retirement, often at rates of 22% or higher for middle-income retirees. The HSA, by contrast, allows completely tax-free withdrawals for medical expenses. And while the Secure Act mandates that 401k owners begin required minimum distributions at age 73, HSAs have no RMDs ever. You control the timing completely. Against a Roth IRA, the HSA still holds advantages. A Roth requires after-tax contributions, meaning you get no upfront deduction. The HSA gives you that deduction while still providing tax-free growth and withdrawals. Ed Slart, a CPA and IRA expert who testified before Congress in 2021, called the HSA the only account that beats the Roth mathematically for its intended purpose. Additionally, the IRS imposes income limits on Roth contributions, with phase-outs beginning at $146,000 for single filers in 2024. HSAs have no income restrictions whatsoever. High earners who can't contribute to Roths can still maximize HSAs. The strategy's foundation rests on a certainty: you will have medical expenses. Fidelity's retiree healthcare cost estimate, updated annually, calculated that a 65-year-old couple retiring in 2023 will need approximately $315,000 to cover healthcare costs throughout retirement. That figure excludes long-term care. The Employee Benefit Research Institute published more conservative estimates in 2022, suggesting a couple might need between $184,000 and $383,000 depending on drug costs and supplemental insurance choices. Either way, the amounts are substantial and create a massive tax-free withdrawal opportunity for strategic HSA investors. At age 65, the rules change in your favor. According to IRS Publication 969, once you turn 65, you can withdraw HSA funds for any reason without the 20% penalty that applies to non-medical withdrawals before that age. You'll still owe ordinary income tax on non-medical withdrawals, making those distributions identical to traditional IRA withdrawals. But the medical withdrawal option remains completely tax-free forever. This means the HSA functions as a traditional IRA with a tax-free bonus option. Financial planner Jeffrey Levine explained to CNBC in 2023 that this makes the HSA a true no-lose proposition after 65. What counts as a qualified medical expense? IRS Publication 502 provides the exhaustive list, spanning over 40 pages. The basics include doctor visits, hospital stays, surgeries, and prescription drugs. But the definition extends further: dental care, including orthodontia and dentures, vision expenses like glasses, contacts, and LASIK surgery, hearing aids, and mental health services all qualify. Surprisingly, most Medicare premiums qualify, though Medigap supplemental premiums do not. Even qualified long-term care insurance premiums count, subject to age-based limits. The National Association of Health Underwriters noted in 2022 that this broad definition ensures virtually everyone accumulates substantial qualified expenses. The reimbursement mechanism creates strategic flexibility. Say you need $10,000 in cash at age 68. If you have $10,000 in old medical receipts, you can reimburse yourself completely tax-free. No income tax, no penalties, no questions from the IRS beyond documentation. Tax attorney Robert Keebler, writing in Journal of Accountancy in 2021, emphasized that this gives retirees a tax-free income source they can turn on and off at will. Need extra money 1 year? Pull from medical receipts. Don't need it? Let the account keep growing. This flexibility is unavailable in any other retirement account structure. If you die with money in an HSA, the tax treatment depends on your beneficiary. According to IRS regulations, if your spouse is the beneficiary, they inherit the HSA and it remains an HSA in their name, preserving all tax advantages. They can continue using it tax-free for their medical expenses. If a non-spouse inherits it, the account ceases to be an HSA and the entire balance becomes taxable income to the beneficiary in the year of death. Estate planning attorney Natalie Choate told Financial Planning magazine in 2022 that this makes spouse beneficiary designation critical and may influence withdrawal sequencing in retirement. Many employers sweeten the HSA deal by contributing to employee accounts. The Kaiser Family Foundation's 2023 survey found that among employers offering HSAs, 74% made employer contributions averaging $750 for single coverage and $1,200 for family coverage. These employer contributions count toward the annual limit but are free money nonetheless. A 2022 analysis by the Plan Sponsor Council of America found that employer HSA contributions had grown 43% since 2019. Crucially, according to IRS rules, employer contributions are excluded from your taxable income, meaning you never pay tax on that money if used properly. Financial planners recommend front-loading your HSA contribution early in the year rather than spreading it across paychecks. The logic, outlined in a 2023 KitCES.com analysis, is simple. The sooner money enters the account, the longer it can grow tax-free. For someone investing their HSA in stock funds averaging 8% annual returns, contributing $8,300 on January 1st versus December 31st generates an extra $664 in first-year growth. Over decades, this timing advantage compounds significantly. The challenge is cash flow. Not everyone has $8,300 available on January 1st, which is why automated payroll deductions remain the most common contribution method. How should you invest HSA funds? Morningstar's HSA research team recommended in 2023 that investors treat the HSA like their longest-term retirement account. For those under 50, they suggested 90% to 100% stock allocation, emphasizing low-cost index funds tracking the S&P 500 or total stock market. For those 50 to 65, a 70/30th or 60/40th stock-to-bond split provides growth while reducing volatility as retirement approaches. After 65, many advisors suggest keeping enough in stable funds to cover several years of medical expenses, while maintaining growth exposure for the long-term balance. The key insight: since medical expenses continue for life, the HSA time horizon extends well beyond traditional retirement age. HSA fees vary dramatically by provider and can severely hamper long-term growth. Morningstar's 2023 fee study found monthly maintenance fees ranging from $0 to $5, investment fees from 0.02% to 1.5% annually, and per transaction costs from $0 to $3. An account charging $3 monthly maintenance plus 1% investment fees on a $50,000 balance costs $536 annually. Over 20 years at 7% growth, those fees consume over $25,000 in potential returns. Consumer Reports highlighted in 2022 that Fidelity and Lively offer zero-fee HSAs with low-cost investment options, while some bank-offered HSAs charge fees exceeding $100 annually. Job transitions create HSA complications. If you leave your employer and elect COBRA continuation coverage, whether that coverage remains HSA eligible depends on the specific plan. The Department of Labor confirmed in guidance that COBRA coverage of an HDHP maintains HSA eligibility, but you'll pay the full premium without employer subsidy. More commonly, workers switching jobs may have a gap before new employer coverage begins. During that gap, you cannot contribute to your HSA unless you secure individual HDHP coverage. However, your existing HSA balance remains yours forever. You can always spend it on qualified expenses or let it keep growing, even if you cannot make new contributions. When you enroll in Medicare, HSA contributions must stop. IRS regulations are explicit. You cannot contribute to an HSA for any month you're covered by Medicare, even if you also have an HDHP. This catches many 65-year-olds by surprise. Social Security Administration data shows that Medicare Part A enrollment is often automatic when you begin Social Security benefits, which can happen before age 65 if you retire early. Tax attorney Robert Keebler documented cases in 2022 where retirees unknowingly made excess contributions after Medicare began, triggering 6% annual excise taxes. The safe approach: stop HSA contributions at least 6 months before enrolling in Medicare to avoid retroactive penalties. Medicare's HSA impact extends backward in time through a 6-month look-back rule. When you enroll in Medicare Part A, your coverage is retroactive up to 6 months, or back to your 65th birthday, whichever is less. According to IRS Notice 2008-59, this means you cannot make HSA contributions during those retroactive months. If you turn 65 in January and enrolled in Medicare in June, the retroactive coverage extends to January, potentially creating 5 months of excess contributions. Medicare Right Center documented this issue in 2023, noting it creates a compliance trap for workers delaying Medicare while remaining employed after 65. While HSAs are tax-advantaged federally, state treatment varies. According to the Tax Foundation's 2023 analysis, California and New Jersey do not recognize HSA tax benefits. Residents of these states must pay state income tax on HSA contributions and earnings, eliminating roughly one-third of the tax advantage in California's top bracket. New Hampshire taxes HSA investment earnings but not contributions or withdrawals. Alabama taxes contributions but not earnings or withdrawals. All other states follow federal treatment. For California residents specifically, tax strategist Michael Kitzes calculated in 2022 that HSAs still beat taxable accounts but lose their edge over Roth IRAs. IRS last month rules allow a full-year contribution if you're HSA eligible on December 1st, but there's a trap. If you contribute the full annual amount based on December 1st eligibility, you must remain HSA eligible for the entire following year. This is the testing period requirement outlined in IRS Publication 969. If you fail the testing period by switching to non-HDHP coverage, the IRS requires you to include the prorated excess contribution in income and pay a 10% penalty. Tax attorney Julian Block documented a case in 2021 where a worker contributed $7,200 in December, switched jobs to non-HDHP coverage in March, and owed $1,800 in income tax plus a $180 penalty. Family HDHP coverage creates strategic advantages beyond the higher contribution limit. According to IRS regulations, family coverage means the HDHP covers at least the account holder and one other family member, typically a spouse or child. Once you have family coverage, you can contribute the full family limit regardless of how many family members are covered. A couple with no children but family HDHP coverage can contribute $8,300 in 2024. If both spouses are over 55, each can make separate $1,000 catch-up contributions to separate HSAs, totaling $10,300 combined. The Government Accountability Office noted in 2022 that this makes family coverage particularly valuable for couples approaching retirement. You cannot contribute to an HSA if you or your spouse has a general-purpose healthcare flexible spending account. The IRS considers this dual coverage that disqualifies HSA contributions. However, according to IRS Notice 2005-86, limited-purpose FSAs that only cover dental and vision expenses do not create conflicts. Neither do dependent care FSAs. Many employers offer this workaround. When you elect HDHP coverage and want to contribute to an HSA, they automatically convert the healthcare FSA to limited-purpose status. Benefits consultant Mercer reported in 2023 that 68% of large employers offering both HSAs and FSAs now use limited-purpose FSAs to avoid this conflict. The IRS requires substantiation for all HSA withdrawals but uses a trust but verify approach. According to Revenue Ruling 2003-43, HSA custodians are not required to determine whether distributions are for qualified medical expenses. That burden falls on you, the account holder. You must retain receipts, invoices, and explanation of benefit statements proving expenses were qualified. The IRS can audit HSA withdrawals for up to 3 years after filing, or longer if fraud is suspected. Tax defense attorney Steve Parrish told the Journal of Financial Planning in 2022 that organized record keeping is essential, recommending digital scans of all receipts stored in multiple locations. Non-qualified withdrawals before age 65 trigger harsh penalties. The IRS imposes a 20% penalty on top of ordinary income tax. Withdraw $5,000 for non-medical purposes at age 50 in the 24% tax bracket, and you'll owe $1,200 in income tax plus $1,000 penalty, keeping only $2,800. This penalty is substantially higher than the 10% early withdrawal penalty on IRAs and 401(k)s. The Tax Policy Center analyzed this in 2021, concluding the steep penalty effectively locks HSA funds for medical use until 65. There are no hardship exceptions, no loan provisions, no first-time home buyer exclusions. The penalty is absolute until you reach age 65. Many HSA providers impose investment minimums, requiring you to maintain a cash buffer before investing the remainder. Morningstar's 2023 provider survey found minimums ranging from $1,000 to $3,000. For example, a provider with a $2,000 minimum means your first $2,000 sits in cash earning perhaps 0.5%, while only amounts above $2,000 can be invested in stock or bond funds. For someone contributing $4,150 annually, it takes most of the first year just to reach the investment threshold. This delay costs growth opportunity. Devonier's research showed that accounts without investment minimums averaged 35% higher balances after 10 years compared to accounts where minimums delayed investing. Unlike 401(k)s that remain tied to employers, HSAs are individually owned and completely portable. When you change jobs, the HSA stays with you. According to Department of Labor regulations, your employer has no claim on HSA funds, even money they contributed. You can keep the account where it is, roll it to a new HSA at a different custodian, or open an HSA at your new employer and consolidate accounts. Employee Benefit Research Institute data from 2022 showed the average worker changes jobs 12 times during their career. HSA portability means you can build one continuously growing account across decades of job changes, unlike the fragmented 401(k) trail many workers leave behind. You can move HSA funds between custodians via rollover or trustee-to-trustee transfer. According to IRS Publication 969, transfers are unlimited and non-reportable. The money moves directly between custodians and never touches your hands. Rollovers, where you receive a check and have 60 days to deposit it into another HSA, are limited to once per 12-month period and must be reported on your tax return. Tax attorney Natalie Choate, writing in 2023, recommended transfers over rollovers whenever possible to avoid the once-per-year limit and the risk of missing the 60-day deadline. Several HSA providers now offer online transfer initiation, completing the move in 5 to 10 business days. Self-employed individuals get an extra tax break. According to IRS rules, if you're self-employed and have an HDHP, you can deduct HSA contributions on the front of Form 1040 as an adjustment to income, not an itemized deduction. This means you get the deduction even if you take the standard deduction, which the Tax Policy Center noted in 2023 applies to over 90% of filers after the Tax Cuts and Jobs Act expanded standard deductions. For a self-employed consultant in the 24% federal bracket plus 15.3% self-employment tax on net earnings, the effective tax savings on an $8,300 contribution exceeds $3,200. The deduction also reduces state income tax in most states. Contributions through employer payroll dodge both income tax and FICA payroll taxes. When you contribute to an HSA via Section 125 cafeteria plan salary reduction, the IRS excludes those amounts from both federal income tax and the 7.65% Social Security and Medicare tax. According to the Congressional Research Service's 2022 analysis, this makes payroll contributions more valuable than individual contributions, which avoid income tax but not FICA. For someone earning $100,000 contributing $8,300 through payroll, the FICA savings alone amount to $635 annually. Over a 30-year career, that compounds to over $75,000 in additional wealth compared to after-tax contributions. The HSA industry has exploded over the past decade. Devonier Research, which tracks HSA data quarterly, reported that total HSA assets reached $116 billion across 36 million accounts as of December 2023, up from just $45 billion in 2018. The average account balance climbed to $3,200 in 2023, though invested accounts averaged significantly higher at $44,000. Growth has averaged 20% annually since 2015. Morningstar's 2023 forecast projects HSA assets could exceed $200 billion by 2027 as awareness of the stealth retirement strategy spreads and more employers offer HDHP options with HSA eligibility. The biggest mistake, according to financial planners surveyed by the Journal of Financial Planning in 2023, is spending HSA funds on current medical expenses instead of paying out of pocket. Among HSA holders, 73% withdraw funds within the same year for immediate medical costs, according to Employee Benefit Research Institute data. This defeats the stealth retirement strategy entirely. By paying a $200 dental bill from your HSA today, you sacrifice decades of tax-free growth on that $200. At 7% annual returns, That $200 grows to $1,522 over 30 years. The optimal strategy is to pay medical bills from taxable savings, preserve HSA growth, and reimburse yourself decades later if needed. Leaving money in cash is the second critical error. Morningstar's data showed 80% of HSA dollars sit uninvested, earning minimal interest. A Fidelity analysis published in 2023 illustrated the cost. $8,300 contributed annually for 20 years at 0.5% cash interest grows to $174,000. The same contributions invested at 7% grow to $364,000. The difference, $190,000, is pure opportunity cost from fear or inertia. HSA provider Health Equity reported that among their account holders, only 18% invest their balances, yet those 18% control over 60% of total account assets. The lesson is clear. The stealth retirement strategy requires investing, not hoarding cash. Failing to retain medical receipts undermines the reimbursement strategy. The IRS requires documentation, and without receipts from years past, you cannot claim tax-free reimbursement. A 2022 survey by HSA provider Lively found that only 41% of account holders systematically save medical receipts. Tax attorney Julian Block recounted a case where a client had paid $60,000 in medical expenses out of pocket over 15 years with the intent to reimburse from his HSA later, but had retained receipts for only $22,000. He could only access $22,000 tax-free. The rest required ordinary income tax treatment. The solution: scan receipts immediately and store them in cloud services with redundant backups. Contributing more than the annual limit triggers a 6% excise tax on the excess amount, and that penalty recurs every year until corrected. According to IRS Form 5329 instructions, if you contribute $9,000 when the limit is $8,300, you owe 6% on the $700 excess, or $42 per year. If uncorrected, you'll pay $42 every year indefinitely. Tax preparation software company TurboTax reported in 2023 that excess HSA contributions are among the top 20 tax mistakes identified in their error-checking system. The fix requires withdrawing the excess plus any earnings before your tax filing deadline. Failure to correct by the deadline makes the excess a permanent tax liability generator. Synthesizing the strategy into an actionable blueprint. First, enroll in a qualifying HDHP, either through your employer or the health insurance exchange. Second, contribute the maximum amount allowed, $8,300 for family coverage or $4,150 for individual coverage in 2024, adding $1,000 catch-up if over 55. Third, front-load contributions early in the year for maximum growth time. Fourth, invest aggressively in low-cost stock index funds, especially if you're under 50 with decades until retirement. Fifth, pay all current medical expenses from taxable savings accounts, not the HSA. Sixth, save every medical receipt and scan them digitally with cloud backup. Seventh, leave the HSA completely untouched, allowing decades of compound growth. Finally, in retirement, reimburse yourself tax-free for old medical expenses as needed, or pay new medical expenses directly from the HSA, all tax-free. This blueprint turns an HSA into a powerful stealth retirement account. Let's model a concrete example. A 35-year-old couple with family HDHP coverage contributes the maximum $8,300 annually for 30 years until age 65. They invest in a low-cost S&P 500 index fund averaging 7% annual returns, consistent with Vanguard's long-term market projections. According to compound interest calculations, this strategy produces $849,000 in their HSA by age 65. If they've accumulated $200,000 in documented medical receipts over those 30 years, they can withdraw that $200,000 completely tax-free. The remaining $649,000 continues growing tax-free for future medical expenses, effectively functioning as a tax-free income stream in retirement, something no other account can match. Unlike 401(k), where employer matching is nearly universal, HSA employer contributions are less common and smaller. The Plan Sponsor Council of America's 2023 survey found that while 95% of employers offering 401(k) provide some match, only 74% of employers offering HSAs contribute to them. The average employer 401(k) match is 4.7% of salary, The average HSA employer contribution is just $750 for individuals and $1,200 for families, regardless of salary. This means high earners get disproportionately better 401k matches but flat HSA contributions. Even so, financial planner Michael Kitzes argued in 2023 that maxing the HSA should precede 401k contributions beyond the employer match, due to superior tax treatment. State insurance mandates can inadvertently disqualify HDHPs from HSA eligibility. The Affordable Care Act allowed states to require coverage of certain benefits before the deductible. If a state mandates first-dollar coverage of services beyond the federally permitted preventive care list, the plan may not qualify as an HDHP. The National Association of Insurance Commissioners noted in 2022 that some state mandates for mental health services, prescription contraceptives, or telehealth create potential conflicts. The IRS has issued limited guidance on this, leaving uncertainty. Most major insurers design plans to maintain HSA eligibility across all states, but consumers should verify eligibility annually when plans change. The Affordable Care Act requires all HDHPs to cover preventive care at 100% with no deductible, and this doesn't violate HSA eligibility. According to IRS Notice 2004-23, preventive care includes annual physicals, immunizations, cancer screenings, prenatal care, and well-child visits. The CARES Act of 2020 and subsequent IRS notices expanded this to include telehealth services and, temporarily, COVID-19 testing and treatment. In 2023, the IRS further clarified that certain chronic disease management services for conditions like diabetes and heart disease could be covered pre-deductible without disqualifying the HDHP. This preventive care carve-out makes HDHPs more palatable while preserving HSA eligibility, addressing one of the main consumer objections to high-deductible plans. Some HDHPs now cover generic prescription drugs before the deductible. In 2023, the IRS issued guidance in Notice 2023-37 stating that HDHPs can provide pre-deductible coverage for drugs treating chronic conditions like diabetes, asthma, and heart disease without losing HSA eligibility. This reversed decades of prior restrictive interpretation. According to benefits consultant Mercer, 42% of employers adopted this feature for their 2024 plan year. The change addresses the criticism that HDHPs force chronically ill patients to pay thousands out of pocket before insurance helps. While beneficial for consumer health, it also slightly reduces the tax arbitrage opportunity since fewer prescription costs need out-of-pocket payment and receipt saving. The HSA stealth retirement strategy is a marathon, not a sprint. It requires discipline to pay medical expenses out of pocket when an HSA card sits in your wallet. It demands organization to save receipts for decades. It needs conviction to invest aggressively when market volatility strikes. But the mathematics, documented across numerous academic and industry studies, are irrefutable. No other account offers tax-deductible contributions, tax-free growth, and tax-free withdrawals. For those willing to play the long game, the HSA represents perhaps the single most powerful wealth-building tool in the entire U.S. tax code, hiding in plain sight as a medical expense account while functioning as the ultimate stealth retirement vehicle.